Also with us here, Linn Ellis, Managing Director of the Linn Group and Chief Investment Officer of Strategic Financial Group. When he was on back in May, he warned that a double dip was possible in the latter half of the year. And Linn, I want to start with you. Is the economic data that you've seen since then just confirming your bearish beliefs?
Yeah, I think particularly in the housing data, if you have yet to connect the dots between the employment situation from 01 through 07, the housing boom, the employment situation today, and the housing numbers we saw this morning, if you are not concerned about the global rate of recovery going forward, particularly into the second half where we have all sorts of headwinds unveiled today by the housing numbers, once government stimulus taken away, the underlying demand extraordinarily anemic, you really just haven't done your homework.
You know, I think most would concede, Lincoln, that maybe growth isn't going to be as strong as we thought. But I don't think most are saying we're going to go back into a recession. And I bring it up because we just talked with Mike McKee about, the likelihood that we've seen a double-dip recession over history. I mean, it doesn't really happen.
Yeah, it doesn't happen very often. And I don't think that actually we will see it in the second half. But we will need to come to grips with what does 1% global GDP look like? What does that feel like?
You really think it's going to be 1%?
Yes. Going into 2011, I think that's the kind of GDP number on a global basis that you're looking at, and the kinds of spikes above and below that trend line are going to be very, very minute.
Which means what for employment? Because you always hear we need 3% or so to add jobs to the economy. So if we're looking at only 1% growth, does that mean we start losing jobs again?
You could, no, because of the way that the unemployment rate is factored, but you could have a prolonged period of extraordinarily high unemployment, and that's exactly what we begin to see. The structural buildup in low employment that we had for the decade from 2000 to 2010 was solely based on housing, and that's gone, and it's not coming back.
I wonder exactly the same thing, Lincoln, when I saw this morning that Tim Geithner comes out and says credit availability is improving. Companies are building up unprecedented cash reserves, which is all true, right? I mean, you can borrow money for so cheaply in these markets, even if you're a big oil company, we pointed out earlier. And as soon as those companies start spending that cash, things could get better. I mean, say you worked for the administration and they wanted you to give your best case scenario. Could you, with a little bit of honesty, do that?
Well, I think Michael's thawing analogy is the right one. Look, we have entered now what is going to be the glacial phase of the recovery. It will be slow. It will be sustained. But it will be so incremental that the kind of thawing that we see, particularly in the small and medium-sized businesses, won't be enough to actually get the liquidity, right, that happens in the friction when you actually get a glacier to move, to provide the kind of job growth that you would need to get growth scenarios at 3.5 or 4, the kind of growth scenarios that you would normally see out of the backside of a recession.
I'm asking for your best case scenario.
So the best case scenario, I think, would be a 1.5% to 2% growth rate where you clipped out maybe 25 basis points of unemployment every 6 to 12 months.
I know you took some time to actually send us some charts, and I really want to get to them. And let's bring them up. I think one looks at net lending from banks, correct?
Which is appropriate, considering Tim Geithner's comments today.
Geithner's comments, and the other piece was on the housing front. Remember all the big banks that we chose to save in the midst of this crisis? We chose to save them because they would begin to lend to medium and small-sized businesses again. This chart simply shows that kind of lending is not happening.
What are we exactly seeing? We've got a white line and a yellow line.
So you're looking at the net lending by the entire financial system and then the combined net lending of all the major money center banks.
Combined is the yellow line.
Correct.
Got it.
And that is way below trend, and that is why you're not seeing this kind of cash or liquidity availability to medium-sized businesses.
Let's take a look at the housing chart here. If we could pull that up. And why don't you explain to us what it is, REO, Speedwagon,
real
or something?
Real estate owned or properties owned by those lenders, in this case, Fannie, Freddie, and the FHA,
right,
who were foreclosing on one home every 90 seconds in the first quarter of 2010. They are now the country's largest landlord, and it shows you that the build in inventories in the REO sector, the shadow-based inventory, continues to grow.
It's amazing that how much. I mean, especially Fannie there, which is in white, Freddie's in yellow, and FHA is in blue. I'd heard actually FHA loans were up some 900% over the past 2 years, but it looks like the biggest growth is at Fannie.
That's correct.
And it's telling you things are not getting better. Certainly not when it comes to the housing market.
They're not getting better, and if you need liquidity in the housing market, that's the only place to go. P.S. They're both insolvent companies.
All right.
That's a good P.S. on which to end it.